You're listening to the Financial Source podcast on YouTube.
Look at the screens today, and it honestly feels a bit like walking through a library. You know, the global markets are trading in these incredibly narrow ranges right now.
Yeah, they really are.
And frankly, there is just this distinct absence of fresh catalysts. It's quiet, maybe a little too quiet.
Deceptively quiet, I'd say. I mean, if you just look at the price action from the US dollar to the yen or even commodities, it looks like everyone has gone out to lunch.
Exactly.
But our mission for this deep dive today is to really look under the hood for you all. Because while the prices are snoozing, the actual central bankers aren't, well, they're actually starting to shout at each other.
Right, and that is the disconnect I really want to figure out today. Let's start with the U.S. We got the dollar index basically flatlining. It feels like demand is just constrained.
It is constrained. But the why is really found in the Federal Reserve's messaging. Did you happen to catch Musalam's comments recently?
I did, yeah.
Right, so he's looking at the data and openly admitting inflation could stay elevated.
Which normally that would light a fire under the dollar, right? That sounds a lot like rates stay high.
You totally think so. But then in the very next breath, he calls current policy neutral and appropriately balanced.
So he just neutralizes his own warning.
Exactly. He's effectively telling the market that, yeah, there are risks, but we aren't planning to move. And that kills volatility. It gives traders absolutely zero incentive to take a big position.
Okay, so the Fed is sitting on its hands. But across the pond, it feels like a completely different story. Green at the Bank of England isn't playing this balanced game.
Not at all. And this is really the key insight we pulled from the sources today. It's all about divergence. Green is explicitly saying the UK shouldn't set policy based on what other central banks, meaning the Fed, of course, are doing. She sees a strong case for moving in the opposite direction.
That's a bold stance to take, because usually central banks like to move in a pack.
Right, they do. So she's really signaling a decoupling here. And meanwhile, you have the euro just floating near that 1.1800 area.
Benefiting from a soft dollar.
Yeah, it's not climbing because the Eurozone is strong or anything. It's just drifting up because the dollar is listless. The euro is essentially just a passenger in this story because it lacks any meaningful catalysts of its own.
Let's swing over to Asia then, because the quiet narrative falls apart just a bit when we look at the yen. It's pulling back and essentially erasing that rally we saw after the Takaichi government made those reflationary nominations.
Oh, it is very messy over there. The market is desperately trying to decipher Takada at the Bank of Japan. He is out there calling for a gear shift in rates because he thinks the inflation target is nearly met.
But a gear shift usually implies action, right?
It does, but then he qualifies it by stressing the need for a gradual and measured adjustment.
So he wants to shift gears, but in slow motion.
Exactly. He wants a slow motion hike. And the market hates ambiguity, so that mixed messaging is hammering Japanese government bonds. They're hitting weekly lows because traders just don't know how to price that in.
Now, in the midst of all this confusion, Australia actually gave us a fairly clear signal.
A surprisingly clear one, yes.
You're talking about the capital expenditure figures.
Yes, they beat expectations significantly. In a market full of maybes, that CapEx number is a hard data point that says Australian businesses are actually still investing. It reinforces their growth prospects in a way we just aren't seeing elsewhere right now.
Which brings us to commodities. We're seeing that same sort of wait-and-see energy in oil, right? It's range-bound despite volatility and a pretty substantial inventory build.
Supply and demand have totally taken a backseat to geopolitics there. Everyone is just staring at Geneva.
The U.S. and Iran talks.
Right. Until the market gets a solid read on those scheduled negotiations, oil prices aren't going to commit to a direction.
Okay, I have to ask you about this gold number. I was looking through the source material and I saw a target of $5,200 per ounce. That is massive.
It's a staggering figure, but it tells you exactly where the anxiety is hiding. That price target suggests a lot of capital is terrified of currency debasement or even a deeper crisis.
So they aren't buying gold for 2% gain.
No, they're buying it purely as insurance. And curiously, copper isn't coming along for the ride.
Because of China.
Exactly. Copper is tied to industrial growth, specifically in China. And since Chinese markets are lagging behind their regional peers right now, copper is capped. It can't break out until China does.
Okay, so to synthesize all this for you guys listening, we have the Fed saying we're neutral. We have the Bank of England threatening to go rogue. And the Bank of Japan trying to shift gears without stripping the transmission.
Oh, well, the actual prices on the screen are barely moving. It's really a pressure cooker. You have this heating rhetoric inside a completely sealed pot.
Which leaves us with this provocative thought for you to mull over. If central banks are explicitly stating they will diverge from the Fed or shift gears, how long can these markets actually stay quiet before the dam breaks?
That really is the multi-trillion-dollar question. Enjoy the quiet while you can.
Thanks for jumping into this deep dive with us today. We'll catch you next time.